The market ended on a very poor note, with many companies deep down into the red, and in particular the focus of today, Nvidia was down just over 4%, and it's going to be a very big week in the market. Many companies will be reporting their earnings, but the one we are anticipating to really drive the market higher or lower is Nvidia, which we will find out after the market close on Wednesday. And we can in fact see many analysts believe the direction of where the market will go will come down to the Nvidia earnings. So there is a lot of pressure, and we may get some volatility leading up to the day. We also noticed that Bank of America believes the overall market is very expensive by nearly every single metric, and this is something we have pointed out when we have looked at the overall companies on a forward valuation, with many of them sitting well above their own 5-year historical averages. In fact, what they say is that we are sitting in a bubble that is exceeding the .com and Nifty 50 era, and they believe the S&P could at some point this year take a massive 40% drawdown. Now, no surprises then, overall the market sentiment by investors is sitting in fear, many unsure of how the shorter term will play out. And when we take a look at what's just happened so far in 2025, we had DeepSeek, which really shocked the market, which was meant to be a low-cost Chinese AI company. Whether or not that is true is something still needed to be answered, but what it did in fact do, especially for Nvidia, was give it the biggest single-day stock decline, where they lost around 560 billion right off their market cap. Now, it wasn't too long ago where Bank of America said that Nvidia will have a very strong 2025. They in fact raised their price target to sit around $190, something that they still believe to be the case. And in fact, even with the impressive run this company has had, they believe we are looking at a generational opportunity in the AI market, in which they see Nvidia growing at a very rapid rate, and this is all coming down to the AI accelerator market, which, as we will show you, comes heavily down to the growth they have seen in the data center space. They in fact believe this generational opportunity to give Nvidia a market cap of $5 trillion, and in fact in 2025 we have seen some analysts revise their price targets, where they believe Nvidia could hit $220. On the other hand, this year we have investors and analysts who believe that Apple stock could be a much smarter AI player than Nvidia. Not something we agree with, but always good to look at other ideas as well as what other analysts do believe. And again, on the other hand, we have analysts who believe that another blowout year is due for Nvidia, and it is going to go significantly above Apple. In fact, they believe the chip maker could more than double its share price again in 2025, which would make it not just the most valuable company in the world, but by a massive margin. Now, if we just look at Nvidia's latest quarter, we can see very impressive indeed. Their data center was up 17% from the previous quarter, and whilst we do know very strong numbers in other categories, that essentially makes the bulk of their revenue, in fact 31 billion, with their total revenue sitting at 35. And we will cover their margins, which are very impressive: 75% on the gross margin, 62% on the operating side, and 55% on the bottom line net income. Now, one thing to note, and analysts will be heavily looking at these numbers, is that their data centers has climbed very rapidly. In fact, 31 billion reported in their latest quarter. In the same quarter last year, it was less than half, sitting at 14.5 billion. Now, whilst these other numbers are still something that analysts will look at, given the size and given the lack of growth in comparison, data center is where all the eyes are going to be focused on. And one thing to note, we will come to show you this again, but Nvidia is a company that does typically outperform what analysts want. Question is though, do we have faith not only they can do that this time round, but can they also offer some impressive guidance that really will blow analysts even further than the high anticipation and expectations they have for the quarter? Now, looking at the company itself, over the last year, it is up 99%. Year to date in 2025, not great at all actually. It's flat and has so far underperformed the S&P 500. Over the last 10 years though, massive outperformance, up 24,300%, and right now does trade at the upper end of the 52-week range. As we can see, had a over 4% pullback just on Friday, and now sits only a little bit away their all-time high at $153. Having said that, something that Wall Street have been very consistent about is that they believe even now Nvidia is a strong buy, something also agreed with Seeking Alpha and Quant, even though they have the hold, 3.5 would flip this onto a buy rating, so they're pretty much sitting on the fence. We will cover this, although very trivial, they do pay a dividend around 0.03%. As highlighted earlier, they are reporting their earnings after the market close on the 26th, and just looking at that latest earnings that they reported, they nearly doubled their revenue, and this significantly came down to the strong AI demand that at the time being doesn't look like it is slowing down. So if we look at what they actually reported in terms of the difference, 81 cents per share on the EPS, well above the 75 analysts were targeting, and the revenue was also very strong, 35.08, well above the 33.16. They also anticipate around 37.5 for this quarter that we are seeing on Wednesday, which was slightly above the analyst expectations of 37.08. But the key takeaway we want to let you know here is that if they do hit this target, that will show year-on-year growth. Remember, this is closing out the year, it's quarter 4, of around 70%, which is slower, in fact, significantly from the previous year, where we did see 265%. And for the quarter that did just end, 94% was the growth on a year-on-year basis. Again, just highlighting here that growth is starting to slow down. As we can see, the previous quarters were showing triple-digit growth, going from 122 all the way to 265. And we always like to highlight the bottom line, which did come in at 19.3 billion, significantly above the 9.24 again from the same quarter last year. That is a more than double on that very bottom line, with gross margins also increasing. We love to see that in terms of efficiencies to 73.5%. Now, as we can see and mentioned, over the last 4 quarters and for quite some time, Nvidia have outperformed analyst targets, giving them a 100% track record. And if we look over the next 4 quarters, they are anticipating double-digit growth quarter on quarter to the EPS. And right now, based on January 2026 of the earnings per share, this company now trades at a forward valuation around 30.3, which does look fairly decent for a very high quality company. That is, if you do believe they can continue that upwards momentum, but it is starting to slow down, at least on the top line revenue. In terms of the sector median at 24, meaning right now you are paying a premium for this company. As we will show you though, it does deserve a premium. The question we want answered though is how much of a premium, and does it look like to be a buy right now? Over the last 5 years, they have averaged around 48, so you are actually getting a discount right now in comparison to their own 5-year, and something that is pretty much consistent no matter which valuation metric you look at today. Nvidia does trade at such a massive premium to the overall sector. In terms of growth, again, probably no surprises, A+, 152% on their top line revenue year on year, significantly not just above the sector at 5%, but also a lot better than their 5-year average, sitting at 63%. Forward looking over the next 12 months, anticipated 94%, again a lot better than both comparatives, 6% and 39% respectively. And then we take a look at the earnings per share, something analysts always love to look at. 38% expected growth over the next 3 to 5 years, significantly better than the 15 and the 27% we can see here, again from their own comparable numbers. In terms of profitability, they get another A+, gross margin 76%, a lot better than the sector at 51, a lot better than their 5-year. This is showing us not only are they increasing their revenue over time, but we're also noticing efficiencies, margins are getting stronger, and the same to be said for their bottom line, 56%, well above the sector at 4 and well above their own 5-year at 33. They also generate a significant amount of cash from operations, 59 billion, well above the sector at 103 million, but also quite some way above their own numbers over the last 5 years at 15 billion. Now, if we just look at their latest investor presentation, we can see that whilst revenue has increased over the last few years, the main driver of this has just been over the last few, going from FY23, where it more than doubled, to FY24. And if we were to extrapolate for the full year of FY25, this would sit around 120 billion, which would be another double from the previous year. Again, bear in mind we are anticipating growth to start slowing down, so whilst they can't continue to double their revenue forever, it is something that does look very promising, especially if they can, and as they have done, been improving on their margins. 34% FY20 to the operating margin, now sitting year to date at 67%. We also like the fact free cash flow has been looking strong, although again, the same thing does apply here, where that massive driver has just been over the last few years, pretty much increased by around 7 times from FY23 to FY24. And again, if we do extrapolate this, FY25 will sit more than double the previous year. We do also notice they have, given the massive amounts of cash they do currently sit on, done some share repurchases, and they have around 46 billion remaining for the end of the previous quarter. Will again be key to see whether they have been ramping this up in Q4. And not too long ago this year, or in the financial year, they did increase the dividend by around 150%. Now, in terms of the different revenue streams and where the growth is coming from, we can see their data center, which makes up 78% of FY24, so the previous year revenue, has been increasing by around 75% year on year over the last 5 years, and definitely the most impressive when we look at the total income streams. The one that comes in second is their gaming, around 17% of last year's revenue, and that has been growing, whilst at a decent rate, only 11%, which isn't anywhere near the growth we have seen from the data center stream. And when we look at that in a bit more detail, we can see again growth just from the last few years, but it has really shot up. Something, as we mentioned earlier, analysts will really be focusing on, at least in the next quarter, and probably moving forwards as well. In terms of what this company is doing, not only showing us their productions for 2024, but also for this whole year, they do have the Blackwell Ultra, but also 2026 Rubin and 2027 Rubin Ultra, something that is very good to see from management. They are forward looking, and it's always good to see where the opportunities lie, and something they have also included in the next slide, where they talk about the $1 trillion worth of opportunities in accelerated computing and generative AI. We have AI factories and GPU accelerated data centers, and in other cases they do also talk about robotics and other areas. But given the fact they are a very key play in the data center, we can see they anticipate this to sit around $2 trillion, and they even say and beyond over the future. So very exciting if you are a shareholder. But looking at institutional aspect, they hold around 65% ownership. They did sell around 68 billion. Now this is over the last year, but the data is really 2024. They bought a significant amount more institutions at 387 billion. But this is something that is very consistent even over the most latest quarter. They bought nearly 3 times as much as they were selling, so still very, very bullish, although we are yet to wait for the full Q1 data of 2025, but we would anticipate a very similar trend. In terms of insider ownership, around 4%, we do notice around 1 billion worth of sales over the last year. Now in the most recent quarter, so January and February this year, we did notice over 5 million worth of sales. Always for transparency, we will show you who these insiders are. Bear in mind though, not something we particularly incorporate into our own analysis, given insider selling isn't bearish or isn't typically bearish because they sell for many reasons, personal and financial. So the most recent sale by insider on the 6th of January, the EVP, selling around 36,000 shares, netting them around $5.5 million. Now, whilst we don't cover congressional members' buys and sells, we have a separate episode for this, but you can see here again for your own information. But one thing that is always closely looked at is Nancy Pelosi's buys and sells, and on the 14th, as we did talk about earlier, she was buying quite a significant number of shares. Now, other things that are very interesting to understand is how this company compares against others in the semi space. Similar size, similar sector, we have Broadcom, TSM, Qualcomm, as well as a few other well-known companies. Over the last year, including dividends reinvested, although fairly trivial for Nvidia, they are the best performing, up 99%, although we can see in a close second we have Broadcom at around 81%. And then if we expand to over the last 5 years, no one comes anywhere close to Nvidia, up over 1,736%, and the same to be said over the last 10 years. But always understand one thing, that past performance is never an indicator of the future. Now, the other thing we want to do to compare, although the answer should be fairly obvious, is against the S&P. Nvidia has outperformed over the last year. It's outperformed over the last 5, as well as outperforming over the last 10. The reason we highlight this consistently is just to show you that when you are picking individual stocks, the main point in doing this is because you want to outperform the S&P, so you need to have faith Nvidia can continue to do something they have done for quite some time. Now, before we get into our valuation, we just want to highlight some key underlying metrics. Starting off with dividend safety, 89, very safe score. We have 2 signals here that we will cover in terms of undervaluation. And as we mentioned earlier, they did in fact increase the dividend in May last year at 150%. And a very safe dividend score ultimately means that a dividend cut for this company is highly unlikely. Now, showing you off some key metrics here from the 07-09 recession. Now, they didn't pay a dividend back then, so no comparative data. They had below average growth, negative 35%, S&P negative 12, but they massively trailed the S&P, negative 78, the S&P itself negative 55. Now, in terms of dividend growth, over the last 5 years, it's only been 1% year on year. Over the last 10, around 7%. But the main one that investors will like is that 150%. And we wouldn't be surprised to see another triple-digit dividend increase over the next few months. In terms of increases, though, we only have that increase we saw in May, but over the last 11 years, they have been paying a dividend without a reduction. Now, the first valuation metric we're looking at is in comparison against the 5-year average P ratio, but remember, we're not looking at any model in isolation. We will run it through our own discounted cash flow process. Now, over the last year, this blue tunnel indicates the expected fair price. Nice to see it is increasing over time, something you want with your companies, but what we notice is that currently it sits well below even the bottom end. There is some disparity here, which does indicate today severe undervaluation for Nvidia. And then we move on to the next model. Now, typically we would look at dividend yield theory, telling us a company is undervalued when the current yield sits above the 5-year, but given they don't really pay a dividend that often in terms of increases, not their focus, we wouldn't deem it to be reasonable. So looking at the forward P, given it does trade significantly lower than their own 5-year historical average, again, another undervaluation signal. As highlighted earlier, though, it does trade at a premium to the overall sector, something that we do believe is warranted given the high quality nature we have run through and will also highlight through these metrics today. Free cash flow payout, again, we can run through it very briefly given it is here, but not a massive focus given the dividend is very small. As always, free cash flow over the earnings, which is susceptible to manipulation by management through accounting. Below 50% is what we want to see. Nice to note it has been decreasing, sitting at 1% in 2024, 1% on a trailing 12 month and over the next 12. This is why we wouldn't be surprised to see a triple-digit dividend increase, and in all honesty, we could even see a quadruple one if they wanted to, although investors would probably like to see them start to ramp up those share buybacks, something they have been doing in 2024. In terms of free cash flow per share, consistent growth over the longer term. We did notice this in their investor presentation, that the real increases have just come over the shorter term. But look at that, over the next 12 months, they really expect it to really ramp up, something investors will love to see. In terms of sales growth, typically 3 to 7%. In fact, 3% is just to keep up in line with inflation. Looking very good, although very inconsistent. Bear in mind, the industry as a whole is cyclical. Triple digit in 2024 will remain to be seen what we get for 2025. And then in terms of total sales, you can see it from a numerical perspective going all the way back to 2015. In terms of shares outstanding, we really highlight this because we want to understand, do companies return excess cash to investor pockets through share buybacks? If you're someone that bought in 2015, they would have actually diluted your position over the last 10 years given the increase, but we can see from 2022 they have started to do the opposite. They have implemented share buybacks, and as we saw from the investor presentation, this is something they are expecting to continue and have quite a substantial amount to execute over the next quarter. ROIC, one of our favorite metrics, 12% or more for the semi space. Give us faith, management are able to effectively allocate their capital, not only above that every single year, but massive 92% on a trailing 12 month. Investors will love to see that, as well as prospective investors. And then we move to the margins, where I'm sure you understand we want here, 1, to be above the 16% minimum, which we get to see, but 2, efficiencies over the longer term. That is an identifier of a high quality company, something that Nvidia meets the criteria, sitting at 63% on a trailing 12 month, and whilst a little bit inconsistent on the free cash flow margin side, nonetheless very strong, double digit every single year, and 50%, very good to see over the last 12 months. Then we get to the net debt to EBITDA, essentially telling us the number of years it would take the company to pay off all of their debt net of cash on hand. We want below 1.5. Remember, this corresponds to balance sheet strength, dividend safety. This highlights over the last 10 years, over the next 12 months, it won't even take Nvidia one day to pay off all of their debt net of cash on hand. A very, very strong balance sheet indeed. Now, before we get to our valuation, we just want to let you know we have released our latest free weekly article. We drop one every single Monday morning completely for free to your inbox, where we cover severely undervalued stocks as well as what's gone on the market over the last few days. New copy coming tomorrow morning, so click below, you can sign up and read straight away, where you'll also be able to gain access to 45 undervalued stocks for the month of February. Lots of information for each one, the upside that Wall Street themselves see over the next year, and on top of that, you can grab a recently released copy of 32 stocks that Wall Street themselves believe have the most upside in the S&P right now, so click below, you can sign up and read straight away. We then move on to our intrinsic value, where our price does remain untouched at around the $180 mark. As you can see, it is derived from the DCF model. Now when we take a look, we have the free cash flow year on year, average growth over the last 5 years, triple digit 135%, over the last 10 years 94%, just in the most recent year 610%. Now we have gone moving forwards at around 25%, but you can see we have a low, medium and high, which is fairly subjective, so you can always grab a copy of this model by clicking on the pinned comment below, running your own numbers, whether it is for Nvidia or any others. But based on 25% with a discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as you can see, $179 indicating 34% upside. Now, full transparency, for those that do believe it should be a lot lower, at the 20% point, pretty much no upside, so this is a good gauge of where the company sits right now. It means baked into the current price is the expectation that free cash flows will grow at 20% year on year. Again, if you expect it at 25%, upside of 34%, and if you expect 30%, you can in fact see $239, 78% upside. Now, regular viewers know that Bloomberg not too long ago did believe this industry would grow at a CAGR of 42% at least over the next 10 years. Now, if this is something you believe over the longer term, then this gives an intrinsic price of $464, which is upside of 246%. That is more than 3 times from the current value. Now, typically we take through the medium rate today at 25%, and we're not done there because we do always apply a margin of safety, 10%, kick off with that, execute on that if it meets our 3 golden criteria, wide moat, strong financial metrics, good forward-looking data. If you believe that in today's episode, a buy at around $162, then we keep going till it's near the current trading price. And what you can in fact see at this value, after the 4% drop that we got on Friday, you're getting a 25% MOS. Wall Street themselves, their price target on average around $180. They see 34% over the next year. But as always, give us your thoughts below. 25% MOS, 34% upside. Is this a buy, hold or sell? Especially with earnings after market close, is this one you're considering adding, selling, or maybe just holding? Don't forget as well to sign up to the free weekly newsletter, grab those spreadsheets, come and join us in the Patreon where we do cover our weekly buys and sells, and we have been making some buys and sells given the volatility over the last few days. As always, have a great day and we'll see you all on the next one.